Hello people, welcome to the Fortune Fastlane YouTube channel. Margin trading is risky because it requires you to deposit cash in a brokerage account to collateralize the loan. You also have to pay interest on the borrowed funds. Margin trading is the idea of buying stock with borrowed money. You will be buying stocks you don't have the cash on hand to invest in, but this will allow you to make larger investments than you could before. The risks are higher than if you had your own funding though. It's important to carefully manage your margin trades. If you want more of this content, Fortune Fastlane, subscribe to the Fortune Fastlane YouTube channel and hit the notification bell. Margin accounts are a type of brokerage account that allows you to buy investments by using someone else's money. When you open a margin account, you may be offered the opportunity to choose how much money you want to use as collateral. Margin trading is a type of secured lending. When you borrow against investments through your brokerage, the borrower is using pledged assets as collateral for the loan. This is similar to how a home equity line of credit is secured by an asset that the homeowner pledges in writing to repay. Investments like stocks can be secured through margin trading. Regulations impose limitations on what you can borrow, with a limit of 50% of the investment's purchase price. Brokerages also have different limits on how much you can leverage for such trading. Let's say you open a margin account and deposit $5,000 in cash, for example. Your broker would allow you to invest $10,000 worth of stocks in the account, but they will charge you an annual interest rate on loan. When you purchase a stock, what you are paying for is a difference between the current price and the strike. For example, if the stock has risen in value and is now worth $56 when you buy it, but the strike price is still set at $50, then you're paying $6 on margin trading. Margin interest will be charged monthly, which goes to pay down that debt. When you sell your stock, your earnings first pay off the loan before going to your account. Margin trading, which is the process of purchasing securities with money borrowed from a broker, is strictly regulated by the Federal Reserve, FINRA, and the SEC. Although brokers have their own rules, these are some of the most common regulations that apply to margin trading. Your broker's minimum margin requirement is the lowest amount you must deposit to buy securities on margin. FINRA requires individuals to deposit at least $2,000 or 100% of the purchase price for margin securities, whichever is lower. The initial margin is the amount of money that you invest in a trade. The Federal Reserve's Regulation T limits how much of your investment you can borrow when you buy stocks, although this is set by individual brokers. Maintenance margin is a percentage of the investor's funds that the investor must keep in their margin account when owning securities on margin. The minimum maintenance requirement is 25%, but it can be as high as 40% depending on the broker. This requirement ensures that investors don't get too far in debt and maintain skin in the game. With margin trading, you open a position by borrowing shares and buying securities on margin. Then you wait for the stock prices to rise so that you can sell your securities at a profit. The biggest risk of margin trading is that the value of the securities will decline instead, which would have consequences for your equity and may trigger a margin call. A margin call happens when the equity in a margin account is too low to meet the maintenance margin requirement. Once this occurs, your broker will require you to deposit more money so that you can meet the requirements. This may cause some financial scrambling on your part. For example, say you open up a margin account and deposit $2,000. Under the old rules, you could invest up to $4,000 worth of securities in that margin account. If your stock investment, $4,000, drops by 10% to $3,200, a broker with a 40% maintenance margin requirement will require you to deposit an extra $800 in cash into your account. Margin trading offers you more purchasing power. This is a big advantage for investors with a cash account. When you buy on margin, your buying power is greater than it would be if you were limited to the funds you have in your account. Margin trading with leverage can magnify profits. That's because securities are worth more when they go up in value. Basically, this means that when securities are worth more, you have more leverage to buy securities and margin. With a margin account, there are no fixed repayment schedules as with traditional loans. You only need to repay the loan once you sell the stock, but so long as you meet the broker's maintenance margin requirements. When you margin trade, you pay interest on the money you borrow from your broker. Interest rates vary by broker and depend on how much you're borrowing and market conditions. Margin interest rates range from 4.75% to 12%. You pay interest no matter how well or poorly your investments are performing. Forced liquidation happens if your broker requests more money and you don't deposit sufficient cash by the deadline. Without notification, it may happen and cause a big loss to you. Accelerates losses. This is the flip side of the accelerated profits noted above. If the value of securities bought in margin declines rapidly, you not only lose your equity investment but also have to pay money to the broker for your loan. If you purchase $10,000 worth of stock using a margin account and use half of the money borrowed from the market, then if the value of your stock falls by 20% to be worth $8,000, remember all the losses come out of your equity. Your account equity becomes $3,000. In this case, you have lost 40% of your cash investment. Buying $5,000 worth of stocks on margin would effectively double your risk. Through our example, you would lose twice as much money if you had bought stocks with an identical decline in price. Only experienced investors should consider margin trading. It's not the best option for beginners because it's generally high risk and can result in heavy losses. Newer investors would be better off using cash accounts to learn about the market and start investing when they're ready. It is a good practice to cover margin trading losses just in case your investments fall in value. Even if you are sure that your investments will increase, the market can change at any moment. If this happens, then they could be liquidated and you would lose out on all of your hard work. There are many ways to buy stocks. For example, one of the most common ways is to transfer money from your bank account to your brokerage account and use that to purchase stocks. However, that's not the only way. Margin trading means that you're borrowing money from your brokerage company and using it to buy stocks. This is just like taking out of a loan and using the lent money to purchase stocks. You repay the loan with interest at a later date. With buying on margin, there is a potential for higher gains, but also a greater potential for loss. Margin trading is a type of leverage that adds to investment returns. But because investments are more high risk, any losses will be magnified as well. Let's imagine an investor wants to own 200 shares of a company that is currently trading for $30 a share, but she only has $3,000 in her brokerage account. She decides to use only half, 100 shares of her cash, and pays the other 100 shares on margin by borrowing money from her brokerage account. The initial investment is $6,000. In this scenario, if the share price rises from $30 to $40, meaning someone invested $3,000 in company shares, at that point she would have earned a profit of about $1,000 since her investment doubled. If she had invested only her own money instead, earning a return in both the initial investment and then borrowing to invest again, she would earn a total of $2,000. It's possible that not every investment is a winner, as this scenario illustrates. The stock takes a hit and the share price drops from $30 to $20 after the bad news is released. The value for investment falls from $6,000 to $4,000 and she only has $1,000 left after paying the loan back. Had she only invested with cash instead, she would have lost half that at just $1,000. And if the price of shares falls even further to something like $10, the investment is now worth just $2,000, but the investor needs $3,000 to pay down the loan. After she sells what remains of her shares, she still owes an additional $1,000. That means a total loss of $4,000, her original investment of $3,000, plus an additional $1,000 that satisfies the terms of the loan. The danger of using leverage is that you can lose more than your initial capital. Margin trading is risky and pricey for investors without the know-how and financial means to handle the loan. It is important to understand the details of margin trading loans if you're considering borrowing from your broker or answering a GTC order. Let's dive into a few key components of margin loans, starting with, like a secured loan, margin loans require the person borrowing to provide some collateral. When you borrow money, the value of your investment portfolio is used as collateral. Usually, brokers will require you to keep a minimum of $2,000 in your account to borrow on margin. The amount of money that an investor is allowed to borrow, called the credit limit, is determined by the value of the collateral. A broker will allow an investor to borrow up to 50% of the purchase price of shares and up to a certain percentage of the amount in collateral in their account. For example, if you want to buy $5,000 worth of stock and put half on margin, you will need enough cash in your account, aka initial margin, to cover $2,500 off that tab, which means you will be able to borrow the other $2,500. Loans take time to pay back. You are charged interest on the loan, which varies depending on the size of the loan. The larger the margin loan you take out, the lower your margin interest rate will be. Take, for example, an investor who wants to borrow $10,000 to $24,999. They would pay 8.70% in interest on their loan every month. In contrast, an investor borrowing $100,000 to $249,999 would have a 7.45% margin interest rate applied to them every month because they have a larger margin loan and thus a different percentage discount associated with it. When assets are sold off and funds are distributed according to priority order, such as first paying off the margin debt, funds are distributed according to how much is owed. First, go into interest before finding your principal balance that was originally borrowed at whatever percentage it was at when borrowing it at the inception of the loan. Margin loans are similar to regular loans, but the difference could be a pretty big deal. Maintenance requirements and margin calls are both about the allocation of assets or funds that are put toward a particular investment. They ensure that assets will work as promised in order to generate a return. With a traditional loan, the value of the asset you use as a collateral has no bearing on the terms of the loan. As soon as the paperwork is signed, those terms are in place. If your house has lost value over the last year and an algorithm on your favorite real estate search engine says that your home is worth less than what you paid for it, that's solely a paper loss. All these events will have no effect on the interest rate or loan approval process. Your lender won't force you to sell your property or possess your car and sell it for cash. One of the features of margin loans is that they allow you to pay a limited amount upfront. That's one scenario that homeowners could easily face. Would you like to own stocks but are worried about the complicated and expensive process of buying them? A margin loan is a great way to do that. Unlike mortgages, margin loans are always tied to your brokerage accounts, constantly changing level of both cash and securities, the loan collateral. In order to stay in compliance with the terms of a margin loan, you need to maintain a certain level of cash and securities in your account, the broker's maintenance level. Otherwise, you will be penalized or deactivated. If the value of your securities fall and the collateral dips below the maintenance level, as can happen when any of the stocks in the portfolio drop, including those you have purchased on margin, your broker will issue a margin call. Individuals with a margin account have strict margin maintenance requirements. If the account value drops below the minimum maintenance level, which is typically 20% or 25% of equity, they risk getting called out and their accounts being liquidated. While they can deposit more cash or sell equities to increase their account balance, many individuals find themselves in this situation because an investor takes profits from one security without first decreasing the amount of risk in the overall portfolio. You can avoid the situation entirely by following the margin call deadline. If you don't meet the requirement, then your broker will decide which stocks or other investments need to be liquidated in order to bring your account balance in line. Taking care of your assets is important, which is why it's understandable that a margin or maintenance call would make you nervous. Stock values are constantly fluctuating, which can make investors uneasy. One way this happens is as a result of increased maintenance requirements by a brokerage firm, which might not have given any notice. And that's it for this video, Fortune Fastlaner. Remember to subscribe to our channel, and if you feel like we have delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work you put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you will start to see results.